All right, let me call this show to order. The fall series that we've had, and we really appreciate RASEI's support, Mike's going to say a few words in a minute, has covered a range of different issues. And for those who missed Lynn and others in our last conference, the Changing Energy Mix, it was a real thrill for us. We had a great set of discussions. Tony Clark was here from the FERC. For those who missed Jeff Bingham in the Schultz lecture, you missed what political discourse can be in this country, and hopefully will be, about energy policy. And for those who haven't gotten to know William Boyd, you're in for a treat when you do. He is a prize and is really the person behind this Energy Innovation Series. But behind him are a lot of other people, some of whom are outside. So I'll ask you to acknowledge them, and hopefully they will get the message. Anna Noskazy and Cactus Flowers here, and I think Jamie probably worked on this event as well. So real hand of applause for all of them. So we in this country face no greater challenges than the ones at the intersection of energy and innovation. This is our last event of the fall, and we end on a powerful note about how do we finance energy innovation. To give you more of the perspective and overview, William Boyd.
Thanks, Phil, and thank you for all your support for this initiative and for being our partner in all of this while you have a lot of other things on your plate, obviously. So it's great to have a dean who's really behind this 150%. I want to thank you all for coming out to our fourth and final energy innovation event this semester. As Phil said, this is part of a series that we've been doing over the last couple of years in partnership with RASEI as part of their big energy series. RASEI is the Renewable and Sustainable Energy Institute here on campus. It's a joint institute between NREL and CU Boulder, and Mike Knotek is the head of RASEI. He's going to say a few words in a minute, but this would not be possible without their support, so we thank them. It's been a great partnership. We are working on a couple of events for next semester, so watch this space. We're thinking about perhaps an event on public-private partnerships and maybe something on electricity markets, so we'll make sure to get all of that information out in due course. I'll say a couple things about introducing the conference and then turn it over to Mike and then to Phil for his first panel. Needless to say, everyone would agree that clean energy innovation and deployment in the United States faces a number of significant challenges in the current environment. Historically low natural gas prices I think are at $3.65 or so today. Many investment scenarios 5 years ago were built on assumptions of gas prices at $7, $8, even $10. This is arguably the most important feature of the current energy landscape. It's something that we've talked about repeatedly here in this series. It's obviously an important piece of the puzzle, an important challenge for clean energy innovation going forward. It's also a tremendous boom to the American economy, and so there are many, many very positive things about cheap natural gas. I think finding a way to keep renewables in the mix, if you care about renewables in an era of cheap natural gas, is a big and very interesting set of policy challenges. There is, of course, also ongoing uncertainty regarding key policy supports, the production tax credit for wind being the most obvious example of one that matters a great deal to the wind industry around the country and here in Colorado. Cheap gas plus policy uncertainty makes life very difficult for renewables. There's declining interest and support from private investors. I think it's fair to say that the great clean tech investment bubble has burst. There are still some bright spots. We'll hear about some of those today. But a lot of private capital seems to be sitting on the sidelines and looking for other opportunities outside of this space. There are big questions about where we're going coming out of this bubble here in the current context. Finally, there's significant competition from China and other countries. That'll be a big focus of our third panel today. Some of these countries, China in particular, have been providing substantial government subsidies and supports for their domestic clean energy industries. Earlier this week, the U.S. International Trade Commission issued a final decision, a unanimous decision, approving tariffs on solar panels produced in China in response to the subsidies provided by the Chinese government for their solar panel manufacturing industry. This has big implications for U.S.-China trade. It has implications for the U.S. solar industry, different implications perhaps for manufacturers than for solar leasing companies. We'll talk about that as well. All of this is in the larger context of a coming wave of substantial investments in the U.S. electricity industry, estimates as high as $100 billion a year for the next 20 years, $2 trillion over the next 20 years, much of that in long-lived assets and long-lived infrastructure, assets with turnover times of 30 to 40 years. The nature and the mix of those investments will obviously have a major impact on our energy future, on our ability to move to a low-carbon energy system. There is tremendous momentum in the energy system. The mix and the sequencing of investments matters a lot. Policy is an important way to affect that mix in particular ways, but sometimes with unintended consequences. The bottom line, though, if we want a clean energy future tomorrow, we better be thinking about how to channel investments today. So taken together, the considerable challenges facing clean energy investment represent a fairly dramatic shift from just a few years ago when there was great enthusiasm for clean energy innovation and significant public and private investment in the sector. I dare say we're not going back to those days anytime soon, and we need to take stock and learn from the experiences of the last 4 years in terms of specific policy instruments and the overall energy and climate agenda. I would also say, and this is an obvious point, that the outlook for clean energy innovation and climate policy is brighter with the re-election of the president than it would have been had the election turned out the other way. But I doubt anyone thinks that we will see significant federal action on energy and climate policy anytime soon. One can only hope that climate change will no longer be the equivalent of he who shall not be named in Washington, and that the parties can come together on energy and environmental policy, but they obviously have a lot on their plates right now, so don't hold your breath. Now, at the same time, there is a great deal happening, a great deal of policy innovation happening at state level, and we should not forget that much of energy law and regulation happens in the states. A big chunk of that $100 billion a year in new investment that I was talking about is going to run through state PUCs. There's a lot to learn from what is happening in states across the country. Just to take one example, the first auction of emissions allowances for California's cap and trade program is next week. That program starts in January. Love it or hate it, we will learn a lot from that experience. So this conference will address many of the challenges currently facing efforts to finance clean energy innovation and deployment in the U.S. It will also examine some of the opportunities out there and some of the policy and financing innovations that are emerging in response to the current situation. The first panel, with Dean Weiser moderating, will provide an overview of current challenges and opportunities in the sector, with specific attention to federal and state policy supports, tax credits, loan guarantees, etc., private investment in clean energy, and project finance. The second panel, with Brad Barenthal moderating, will address the specific challenges facing VC investments in clean energy, specific issues in key sectors, wind, solar, smart grid, and strategies for securing finance in the current environment. And then the third panel, which I will moderate, will discuss several larger contexts for clean energy finance and their implications for the sector in the United States, including the role of government supports and industrial policy in leading countries around the world, the development of new models for energy innovation finance, and the connections with trade law and international competitiveness. We've got a great lineup. I want to thank all of our panelists for coming out on Friday afternoon. I want to thank all of you for coming out on Friday afternoon as well. We're going to follow our general format here, where we have a structured discussion with the moderator and the panelists, and then we'll open it up for Q&A. We'll give preference to students for the first few questions, but we do want to give others an opportunity to participate in the discussion. We'll take a short break after the second panel, so we'll roll right through the first two panels, take a break, and then come back for the third panel, and then there'll be a reception over in Bedford. So thanks, and I'll turn it over to Mike Knotek, the head of RASEI, to say a few things before we go to our first panel.
Well, I also want to thank everybody for coming today. RASEI, as William has said, is a partnership between this university and National Renewable Energy Lab. And what we're trying to do is take the tremendous resources in this area, and that includes every aspect of this university, certainly NREL and all its programs and resources and people, but also the other government laboratories in the region. It's a very unique mix of institutions here, all of whom have dramatic energy missions, NOAA and NIST and INCAR, and USGS. Just the wind industry alone involves 12 federal agencies, and many of them are right here. And part of what we're trying to do is get these people, get the ferment going and get the dialogue going so people become aware of the many aspects and dimensions and complexities of the energy business. And so one of the things we're doing is instead of having a RASEI seminar series, we have basically seeded a dozen seminar series, including NOAA, just like this one, around the campus to bring in energy speakers, energy topics, with the thought that we'll start generating interest in things here, bringing people who will want to come here and be part of this. So we have new faculty lines. We're trying to, right now we're in the middle of hiring 24 new faculty around the campus in energy areas. So we're trying to create a campus-wide, really energy awareness, get a lot of people here who know what's going on, with the thought that we can now start doing some things that are going to make a difference in the big picture. I come out of the DOE National Lab System, so I've been involved in all the really big institutions in the Department of Energy, but in all of those institutions, the mix of things that are here are simply not there, and they are absolutely critical to solving the energy problems that William just discussed. I mean, this is one of the most complicated periods in energy in a very long time, and even though the horrific invective has somehow pushed climate off the table into the back closet, Mother Nature doesn't pay attention to those things. And the fact is, climate is proceeding. If we bring in the climate experts, they'll tell us it's worse than they thought, and it's moving faster than they thought. So it still remains the challenge of the century. And the question is, how do we get through this period where we have so much ferment in the political and social and certainly technical and energy world to find a path so by mid-century we're on the right track? Because if we're not, believe me, it's not going to be a fun place to live. So anyway, we're trying to help make that happen. And just an example of what we're trying to do. Here we're talking about finance, and I'm a real amateur at finance, so I won't try to offer opinions there. But one of the things we did just this last year is we set up something called the North American Wind Energy Academy. And what it is we got all of the research establishments across the country, and many in Europe and in the Far East, and certainly in Canada and Mexico, to really form a group called the North American Wind Energy Academy. And the job there is to really form a place where we can talk about the challenges of getting wind energy beyond 20%. You go from today's world, which I kind of view as opportunistic and sort of a quantitative progression of that field. To get to 20% and 30% and 40%, it's a qualitative shift because it brings in almost every aspect of business and industry in this country. And so we're trying to get those people, all the major research establishments, industry, there's dozens of those, as well as national labs, to look at the engineering issues, look at the issues of integration in the national system, look at the issues in terms of what are called weather-driven energy systems, wind being one of those. So we involve NOAA and the atmospheric sciences community, the climate community, but then also the policy and regulatory and business and finance and social side of the thing, as well as environmental, to form an integrated picture so when we come through this period, however long it's going to last, the wind comes out the other side fully competitive on a level field, to get rid of the need for cost incentives or production tax credits or anything like that. Make it competitive at scale with anything that's out there. So that's just one of the things we're doing, trying to do the same thing in grid, trying to do the same thing in things like solar technologies of various kinds, buildings. So that's our view and our approach, and these kind of gatherings are just part of that, is to get this kind of expertise in the room to try to talk about these aspects. And we try to find a venue across this campus so more people start coming to these from other parts of campus, other parts of the energy enterprise in Colorado, So we start being the place that's going to solve these problems over the next 20, 30 years. And I'm reminded in terms of, you know, I worked in the climate community for 25 years. And I had in my organization the people who did all the sort of techno-economical interactions between humanity and the climate. So they feed all the models to the IPCC people to give the parameters. And I got all infatuated with all the wonders of that, and these are economists. And one of the big things about that was understanding discount rates. So I got all infatuated with discount rates. So I went to my big buddy, the economist, and had him school me on discount rates. And so he treated me like a puppy. But he was, and the important thing is he said, look, you're a physicist, and I'll tell you all about this, and we'll study it together. But promise me you'll never try to weave it into a presentation somehow. Just don't ever say discount rate in public. And I feel kind of the same way about finance. I know how critical this is and what a very difficult time we're in. But I'm going to be listening with rapt attention here of how you plan to solve these problems. So with that, I'll turn it over to Bill.
All right, I'd like to call up our panelists, and we have a powerhouse first panel of people who are doing it in the business world, legal world, and specifically some who've been on multiple sides of this. Yeah, you guys have your... So you'll see the pictures and bios in your guide. I won't introduce them all by their names, many of whom are familiar faces here, some new faces here as well. And I want to start off just with some level-setting questions that I'll have a couple of people do, providing context, then we'll have a more general discussion, then we'll get the audience involved. So it's a little bit of a moving target, Mike, in terms of the federal regulatory and financing environment of how we support and encourage financial availability and sources for energy innovation. For those who haven't kept score of where we are, can you kind of give us a quick high-level overview of where we are on things like loan guarantees and tax credits in the energy innovation area?
Sure. Well, loan guarantee program, as you probably know, is pretty much settled. There's not a lot of movement or appetite to continue the program.
Now, is that as a legal matter, how much longer is there authority for it versus a practical matter? The whole Solyndra thing has gotten so much a black eye that it's made it a little bit of a harder environment.
Well, I believe there's still money within the 1703 program. I haven't tracked it recently. The reason the 1705 program was so effective and so, at least not with Solyndra, but with getting generation projects built and in the development stage is that it provided this credit subsidy through the ARA program. In 2009, there was a lot of money available for entities to enter that program without having to put up their credit subsidy themselves.
So because you spoke in code, I want to help people follow up. Energy Policy Act of 2007, sections, do you say 305 and 307? Was that?
Oh, I don't know that.
Whatever the relevant sections were. This was a bipartisan law that was passed. Jeff Bigman talked about it to provide loan guarantees. However, the loan guarantee program got a lot more financial heft under the Recovery Act. And it had started under the Bush administration, but with the financial support of the Recovery Act, the Obama administration ended up putting a lot of these loan guarantees out there, which essentially lowered the cost of capital and increased the availability for a number of energy innovation companies.
That's right. But now we're currently past that environment. That deadline, I believe, was last September or so. So now entities would have to put up their own credit subsidy, which is something like 10% of what they're borrowing. And also there's just simply less movement to get anything done apparently under 1703. Within the tax credit world, the big bang for the buck for that's being provided by the federal government. Obviously, PTC is about to end, and there's probably going to be some movement or some.
Again, for those not deep in it. PTC, production tax credit, which is for wind, right?
That's for
But the
wind
solar
and for
one,
geothermal.
but solar still exists. They still have their tax credit for a couple more years, right?
That's right. That's through the investment tax credit. That's a 30% of the initial capital invested, and that extends through the end of 2016. And right now, there's an understanding that that we need to get beyond that. And the Department of Energy has the Sunshot Initiative that we're part of, which is to bring down the various components of renewable costs. And part of that is to bring more capital at lower cost, most likely away from the ITC and more towards accessing the public capital markets.
So that's very helpful. Before we move to, let's call it more traditional sources of public capital, Reuben, you had the experience, right, of being firsthand involved with this loan guarantee program. Can you offer a little more context and texture? Because for most people to hear that, they just think Solyndra, and there's obviously a lot more to it than just that one case study.
Sure. Thanks, Phil. There was a third program that was also entitled under the 2007 Energy Policy Act, but was also funded ultimately through the Recovery Act. Actually, it was funded prior to it, but really unleashed with the Recovery Act, and that was the Advanced Technology Vehicle Manufacturing Program, which, contrary to the Title 17 programs, actually continues to retain a great deal of funding. It was a $25 billion face amount loan program with a $7 billion sort of authorization of loss reserve. And one of the challenges is both as a participant, as an implementer of policies like this, where you have this concept of allocated loss against a loan. And so it's really easy to make a grant. You know when you write a check to a grant that the money goes away, that it is effectively spent. And in a loan, you're trying to manage policy goals with some mitigation or allocation of a loss reserve that in some ways under ideal policy circumstances, you lose all that money, right? That is a risk allocation from Congress that said, we want you to risk almost 25% of your total capital, and if you lose it, that's fine. However, Congress is, one might say, fickle. And Solyndra and their reaction to an actual realization of that loss is a good demonstration of sort of the catch-22 that a policymaker is put into, where the idea of subsidizing capital into risks that are not otherwise financeable by the private markets is something that government can do, but it's actually very hard to implement and actually articulate.
And really hard if you pretend that it isn't an inherently risky endeavor.
Yes.
Which was the fiction around the program.
Exactly. And so one of Vision Ridge's first portfolio investments was creating a company that was actually ideated within the Rocky Mountain Institute, and in 2008 we were the lead investor in the creation of Bright Automotive. And Bright submitted its application and became, entered into this evaluation process at the end of 2008. To give you a context, we went through 2 diligence review periods, each taking over a year. And a review process of that magnitude and duration leads to a series of circularity of chasing your tail, because running an entrepreneurial company, over the course of a year, your business changes, your partners change, your contractual agreements change, and in a government-controlled process with a ton of subcontractors, they don't iterate quickly. And so there's sort of a massive mismatch between the evaluative process in the DOE and then the executory process, as a counterparty. That then led to 4 different, non-binding term sheets against which we fully negotiated. And so you would negotiate a term sheet. It would then go within the loan program department to another entity that had a different viewpoint on risk than the program officers, and they didn't communicate. It was sort of a construct that wasn't one that was, you could get everyone in a room and say, well, what do we all need, and negotiate with a traditional bank, and in the government construct, it was sort of an unfixable problem. I think that's part of what led to a lot of the noise you get where political appointee officials or external to DOE political officials are pushing, because that bureaucratic structure was broken. And so we went through processes and then a political environment that continued to change that risk appetite. So for a $300 million loan, at first $120 million of equity was sufficient in one term sheet. In the next one, $240 million of equity was sufficient. In the third one, it needed to be $350 million of equity, and every dollar of that was spent before we could draw on the $300 million loan, which...
Why bother?
We said, if we could do that, we don't need your loan.
Yeah.
Effectively wrote a letter to that effect when we withdrew from the process in March of this year. And I think that the challenge after the successes of the program's effectiveness in the first 6 months of the Recovery Act, so they made 4 major loans in 6 months, and then 2 loans over the ensuing period, and continue to effectively solicit applications, it is worse to have a program that doesn't lend money than to have no program at all. Because the private market is then looking to this program for validation, effectiveness, and uncompetable with cost of capital, because it's government money, it's like 1% money. But if the money's not going to flow, you need to do something different. And so this sort of failed process is worse than nothing. And that's very contrary to some of the project finance, where they really did lead a path down lower cost of capital in particularly at scale utility projects, right? So we've seen the private markets finance at $1 billion, a public bond at 5.75%. That was enabled by DOE 1703 loans. So I'm not a critic of the whole thing, but
until you said that, I actually thought you were, by the way. I'm glad you said that.
But I have a tremendous tension between where can they successfully intervene and where can they not. And then if they're going to intervene, what is the executionary metric? Because you need a better private finance mechanism in the process.
Well, you've got a lot of people nodding, so let me start with Mark and ask the question that Reuben, his bill in particular sure sounded like leading up to an indictment, but then he backed off at the end. Would you go all the way, Mark? Was this program a mistake?
No, Dean Weiser, I don't think so, although I absolutely would echo all of Reuben's concerns and issues based on my experience with the programs, and particularly my most recent experience, which I'll describe a little bit. None of the information I'm giving you is private. It's all public information. But just a few weeks ago, we got first funding on a 1705 American Reinvestment.
Just for those of us who are not deep in, 1703 versus 1705, obviously 2 flavors of the same program. How do the flavors differ?
1705 is a loan program. 1703 is more of a guarantee program.
1705 are the actual government doing loans. 1703 the government guarantees private loans.
1705 the Department of Energy is actually making a loan to the project. Sempra Energy is the sponsor of this project. It is an 800 megawatt solar project located in Arizona. The loan sought from DOE under the 1705 program was a loan to construct and complete and operate the solar project. It was eligible for 1705 because at the time the application was made, the inverter technology used in the project were innovative design. That qualified it for the financing. Roughly a year and a half from application for the loan to signing of the loan documents. Roughly 1 year from signing of the loan documents to first funding. Okay? The loan documents were signed 3 days before September 30 last year, before the period expired. During that period of time, we had to deal with a complete redesign of the market in California. The project sells energy to Pacific Gas and Electric in California. We had to deal with and adapt to a massive market redesign in California that introduced a concept called delivery capacity or deliverability capacity. The project couldn't turn itself on and sell power until those new and emerging parameters were met. We also had to deal with an upside-down world of tariff wars during the period because this project uses Chinese, Korean manufactured panels. We didn't know what the cost of our panels were going to be, and as as Reuben said, these things don't iterate very well. You can't just stop and start. We're now looking at a project that has construction assumptions based on 2010, 2009 data. All of that said, at the end of the day, the project is borrowing about 53 to 55% of its total cost, $800 million, from the Department of Energy at what should be fairly competitive rates. If the program works, great. If it can work and respond and react within a reasonable time period, great. If it can't, don't bother, because the reaction that's engendered is the public sees that there are these programs and says to the world of people who are developing innovative renewable energy, what are you complaining about? What's your problem, Reuben? You got a loan guarantee. You got a federal, loan. What's your problem? Well, it's what's behind the curtain that's the problem usually. So challenging, but not impossible.
Adrian, do you have a more or less generous take on this program?
We never benefited directly from any of those kind of proposals or programs, but I think about 25% of our utility customers have taken advantage of some form of federal loan guarantee or underwriting of their projects. It had an incredibly distorting effect at the beginning. There was a reasonable capital flow, and then the stimulus came up and slowed everything down whilst everybody waited to understand whether they were going to get stimulus dollars or not. So that was an unintended consequence of the program. And then there was a sort of rush to fund a number of projects, and I would say on balance for me and for the industry, I think it's been positive. I think that things that wouldn't have got started, that have started to yield significant, meaningful results, are really going to galvanize the next phase of this industry, and so I'm a net believer. Although I subscribe to a number of the views that are in here that it could have been, with hindsight, managed better in order to better dovetail with private capital.
Jim?
Yeah, so I think Reuben kind of identified maybe a key distinction between between deployment of proven technology, where I think a program like this makes sense, and financing kind of the scale up or maybe first commercial scale manufacturing for an innovative new technology, where I think this program made no sense as far as it's designed. So if you go into the private sector, you can borrow money to deploy proven technology to generate solar and wind. You could, and you have loan agreements, and you have covenants, and you have all that stuff. And so borrowing from the federal government under maybe more complicated loan agreements, but nonetheless the same. I mean, that's a financing model that has been proven in the private sector. It works in the public sector. If it's a lower cost of capital, God bless, right? But if in the private sector, you don't find private sources financing, scale up of immature technologies with loans, with covenants, with all that kind of stuff. And that's essentially what was being done here. So you're sort of pretending that this is that something is inherently risky, which is scaling up a manufacture of a new technology. You're sort of pretending that it's not risky, but it is.
So you used Solyndra, which is obviously an overused example. Was the government, or Bound Solar maybe, was the government basically acting as a venture capitalist? Was that in function what was happening?
Well, in essence, but they weren't behaving like one. Right. So they were taking venture capital risk, but the loan agreements are full of covenants, and particularly in the background, you have Darrell Issa and his committee was starting to get revved up. So all of a sudden, the level of risk aversion of the people in DOE making decisions about what to do if a plan is off by a week or something, people sort of froze and they couldn't deal with it. So, I mean, you couldn't have designed a worse program if your objective was to encourage, subsidize the scale up of immature technologies.
So I want to, Jim, stick with you on this and another question. So I was with you. We went with Governor, then Bill Ritter, to visit folks in the Bay Area, including John Doerr, and he, at that point, was very excited about the VC opportunities in clean tech. Some have said, looking back, there was a clean tech VC bubble. One question is, you had all this capital coming in to the clean tech sector from VCs. Then you have the government putting in more, in effect, in these loan guarantees. Now you have this, say, bubble burst. Does that narrative hold up, do you think? And if it's overdrawn, how would you explain what we've gone through in the last 5 years in clean tech investing?
Well, so anytime you have a dramatic increase in the amount of capital chasing opportunity, there's going to be, casualties out there. I mean, we ran that experiment in 2000, and the next 3 years were pretty grim, and we're looking for that again. So just inherent in the process of starting lots of companies, you're going to have a lot of failures. But here you layer on the incredible competition from China on PV, which just killed the business. I mean, nobody in the world is making money making panels right now, and as recently.
And by the way, there's now articles in China asking how are they going to manage to rationalize their sector that they've pumped up.
The Chinese government would love to see consolidation there because everybody's losing money, but a lot of these companies are propped up by loans from Chinese banks, and they don't want to take the hit any more than U.S. banks like to take the hit on their, crummy real estate loans. But as recently as 2011, there was $1.8 billion that went into solar VC investments, and I bet you, at least half of that was written off within less than 12 months. So that's that's sort of one. Then you've got, cheap natural gas, which sort of surprised a lot of people. So what does that leave out there? Well, I think where people are going to stay away from is obviously where you're at risk of getting eaten alive by China, where your business plan is dependent on subsidies that may or may not be there, where you don't have a viable economics against cheap natural gas, but that leaves lots of other stuff that you can go after. So stuff that involves, I think there's a lot of opportunity in efficiency plays, and particularly business-facing efficiency plays, where you can show a payback within a few years, and you're not, you don't need to raise hundreds of millions of dollars to execute on that. A couple local examples. LED lighting. I mean, Albio and Terralux both raised money locally in that space and are doing, they're making money, right?
So you've nicely teed up Adrian. Adrian, you are now in the process of financing an innovative company doing exactly what Jim said in the wake of a, let's call it, bust or contraction in available capital. How much is that fallout affecting you, and how do you see us getting through this aftermath?
So, good question. I think, I've raised venture capital in various businesses over about 20 years, and I've learned in that time that there is always some form of boom-bust cycle going on in venture. So my experience of it has been that some smart guy finds a company and invests in it and does well, and then lots of other venture capitalists pile into that sector and overfund it. And the sort of IQ per dollar goes down in terms of the smart investment that goes in, and then that collapses. The people who were never specialists in that space pull out, and you're left with smarter money in the industry. And so and that's exactly what's happened in this cycle. So Tendril's been is about a 6-year-old business at this point, and it's raised 4 or 5 rounds of capital. The first one was tough. The second 2 were heavily oversubscribed because we were right in the middle of the bubble, and we were great terms, and we were turning down all sorts of fantastic offers. It's gotten leaner in the last 12, 18 months. And my experience of it is that you have to try to stay focused on people who understand the industry. And those people are still making investments, albeit they have portfolios of companies where they had hoped that they would have had exits by now, and the allocation of capital to existing portfolio companies as opposed to new investments means that there isn't as much capital around. And so in Tendril's case, we're relatively lucky. We're not a hugely capital-intensive business by the standards of the sector. In other words, we don't have huge manufacturing needs. I think my investors would argue that we are overly capital-intensive for a software business. But and And so in our case, we're able to throttle and control essentially profitability and drive our business to the availability of capital. Not everybody has that luck. And you know, I've just come from a board discussion last week where the conversation went like this. I sort of pitched the board and sort of said, look, we can continue to do what we're doing, which is essentially raise fairly significant chunks of capital to grab as much of this market as we can but understand that the terms under which we get that capital are going to get increasingly worse, and that we're going to be more and more focused on the existing pool of investors in order to fund that operation. So that's one option. Second option, sell the company. You know, it's a viable going concern. Is now the right time? There's a lot of large industrials sitting there with historically high balance sheets who could take this on. And the third option is just run the business as a profitable business, or close to profitable business that has very little external capital needs. And we picked the third option because we have the luxury to be able to do that as a software business. I think others with large manufacturing operations don't have that luxury, and that's the story you wake up to seemingly weekly at the moment, of selling this business at 6 cents on the dollar to somebody or other who picked up the assets because you ran out of capital at a critical point. And I think it's incumbent on every CEO to think through think through what their options are and play the best cards they can.
So Reuben, you're one of those people with smart money in this space, and as you look around, do you think Adrian described this about right in terms of the cycle we're in, or is there more you want to add to that?
Yeah, thanks. I mean, first, no one's been proven yet to have smart money.
Smarter money?
You know, being alive is a sign that either, you know, you have patient capital, or, you know, so we'll see. I mean, I think there are 2 points I would make. One is the narrative is being framed in a very small niche of the market. So if you're actually in early R&D and technology, things like ARPA-E and other actions of the federal government have us in a more dynamic, high investment phase on the 10 to 15 year out technology than we've been in a long time. We are also at a very attractive place for scaling capital, right? The project loan guarantee programs are driving more interesting, you know, other than the wind problem, more interesting large capital deployments than we've seen in a long time. Jeff Immelt would argue that clean technology has been very, very good for GE. They've closed some businesses, but it's now a $25 billion in revenue business. So the framework within the venture capital realm may be more about doing the wrong things or not being a venture capital industry per se. And so, you know, if I flip around my hat, right, before I became a venture capitalist, I was a deep value investor. So this is fantastic time to be in the industry. Right, we have term sheet signature pages in escrow on a Series B round on a company that has done 5 rounds of preferred capital. Now, that means A, B, C, D. It's a good thing as a new investor to get to be Series B again. Now it's a mess legally to execute the changes in all of those other people's lives that get that opportunity to us. But you know, that's the dynamism where you can do recapitalizations on, and it's not Adrian's business, but you can take someone who's done something very, very well for 6 years, and where a lot of money has been put against the idea or the thesis, and invest at that tipping point. So I think the people that are still active are overwhelmed with good deal flow, overwhelmed with attractive economics, and so it becomes a question of where you want to play and how can you take the lessons learned. So it's exciting if you've switched sides of the table.
So the one thing that was mentioned as a real positive sign, you said it, and I can't remember, someone else said it earlier, is project finance and larger projects that we know how to fund. Mark, you've worked on some of those. What about that framework is working, and why?
I think everybody kind of has what I describe as a pre-colored coloring book sense of what's happening in project finance at the large scale in renewable energy, and that is to say that things were pretty good for a while, things got a lot worse, and then everybody has the question of, are they any better, and where are we going? So maybe I'll take 2 or 3 minutes and use some crayons to enrich the picture. Again, a couple of examples, no confidential information here. 2004 Project Finance Magazine's Global Renewable Energy Finance Deal of the Year was a deal where we represented the borrowers, developers, owners of 3 wind projects. It was awarded Deal of the Year because it was the first ever portfolio financing of multiple renewable projects in the U.S. We put 3 wind farms together, 2 in California, 1 in Wyoming, on behalf of the owners, which were a partnership of Shell Renewables and Goldman Sachs. Borrowed against the 3 projects, and the structure was briefly like this. We, on behalf of the borrowers, prepared a disclosure memorandum describing the projects, describing the characteristics, features, advantages, disadvantages of each, and we prepared, in addition, a comprehensive set of about 1,000 pages of loan documentation, which were to be the standard for the transaction. We distributed that massive information package to 19 banks around the world who were in the renewable energy project finance arena at the time. We said, give us your pricing for this loan and your sizing for this loan based on the package of information we've submitted to you. 17 of the 19 banks responded. The loan amount approached roughly 70% of total project costs, and the margin or the interest rate paid by the borrowers on this transaction was about 115 basis points, 1.15% over the applicable LIBOR rate. So very, very aggressive, very favorable borrowing. 17 responses. We selected 1 bank, negotiated to close the transaction, all in the space of something less than 6 months. Okay, fast forward. We completed a project financing earlier this year on a wind project located in the state of Alaska. Admittedly, a bit more challenged project from technological construction standpoint than the other ones I'm talking about. But at the end of the day, rather than 70% of the project being financed, about 60% was financed. Rather than 115 basis points over LIBOR, the interest margin was about 3 times that. And in that transaction, there are a complex series of prepayment triggers, which if anything goes wrong in any way, over the course of the 17-year term of the loan, mandatory prepayments of the loan will be made by the borrower, including any curtailment of any kind because of wildlife or avian issues, which were not an issue in 2004, including because of any interference with or interruption of deliveries of power for any reason. The market has gotten significantly tighter. It's significantly more challenging. Where are we going from here? Well, and the other thing I should say is 19 banks we solicited for the 3 Winds project, 17 responses. When the borrower on the Alaska project commenced negotiating with banks, they found 3 banks to talk to. 2 of them fell out within 3 weeks. 1 fell out immediately, 2 fell within 3 weeks, and we had 1 bank to negotiate with. That's the change. That's the difference. The money is still there, and it's still true that any bank in the world will loan Dean Weiser $100 million tomorrow, as long as he's got $100 million of cash collateral to post to back the loan. That's how the banks are thinking now. There are fewer of them. They're thinking harder. They're scrutinizing the projects more closely. And there are some solutions to that, but I'll stop there.
So Mike, I want to take back to the big picture we started. We did have a good amendment by Reuben on ARPA-E. So just at the very beginning, we'll come back to it. You know, basic R&D, trying to come up with, say, new storage technologies. Then to just that next stage where I think ARPA-E would fit in. Then you get to maybe riskier loan guarantees that are like venture, and then you get to maybe more project finance when it's a little bit more clear you've got the revenue stream. As you look at that whole pipeline, pardon the metaphor, where do you see the biggest concerns about the capital system not functioning well in this area, and what, if anything, can or should we be doing about it?
Well, my research really focuses on the project finance and getting commercial technologies deployed. And I can speak to that more readily, that system, it works. There's a lot of gyrations that people take to utilize the tax credits that are there, as well as the depreciation benefits. But really we need to get to a much higher level of deployment. We need to be able to access capital from sources that currently aren't available, such as pension funds and private wealth, family funds that would invest in something that's liquid and tradable, a product that you can buy and sell, sort of like a mutual fund of stocks, something that would represent a security that represents a pool of renewable energy projects, whether they're solar, residential in the East Coast, or commercial in the West Coast. But that's kind of where we see
A fund of funds, if you will, or?
Well, it could be either an asset-backed security that represents something like auto loans or student debt or credit card debt currently, or it could be master limited partnerships if that opens up to renewable energy technologies beyond geothermal.
But you're just saying if you could aggregate enough of these different projects together in an instrument, that might enable more capital to be put into it. Is that the?
That's the premise.
That's the premise.
Right. So that's where we're really focused in, is how do we sort of standardize the projects and the evaluation practices so that these projects can be really readily pooled and sold as a security, and attract capital that doesn't want to invest in projects per se, but wants to invest in a security that has a lot of liquidity.
Reuben, do you buy that premise?
You know, we had the opportunity to listen to your collective group's introductory statements, and I took strong distinction with William's comments around the lack of action that can come to move the needle in this industry, because legislative action, I think, is a big challenge. But you know, there are a couple of big levers. One of them, you know, is around coal regulation and coal plant regulation, which is an EPA action. Another executive branch action is exactly what Mike's just talking about, right? Which is getting real estate investment trust treatment and or master limited partnership treatment for a number of these pools of assets, because you know the MLP standard has been broadening already, and it's including some relatively peculiar businesses from the traditional, you know, oil and gas transmission activities. It's starting to look, you know, the risk is it's like the Canadian investment trust trend, where it started in real income activities and ended up in laundry, you know, machine laundromats as public finance yield equity plays. But similarly, though, right, a master limited partnership in these other industries is a 6% liquid yield instrument for equity. And so in renewables, if you could get project equity at 8 or 9%, it's a really attractive role to be the aggregator and bundler of those in the private markets at 12+%. But B, that starts to access, that becomes much more attractive, and the scale of capital available is much, much higher. The challenge is that a lot of these projects are very people and knowledge intensive. So, you know, a sub-utility scale solar project is brain damagingly unique, technologically, structurally, and it deploys $5 or $10 million, which...
Well, that was my question and concern, which is that when you think about the mortgage-backed securities, we learned that not all mortgages are created equal. And if not all these projects are created equal, does the whole instrument hold up, or do people say, I need to see behind the curtain a little bit more?
Can we pick a fight? Would that be good?
What's that?
Can we pick a fight? Would that
Sure,
be good?
I was going to wonder whether you or Jim were going to take the bait, so you two go first.
I hope none of my clients are in the room. I don't think that renewable energy investments belong in the hands of the investing public on the scale and to the extent that master limited partnership or REITs would allow them to be. And I think that not as a matter of setting up a structure that would allow companies in the industry access to the lowest possible cost of capital and capital that's freely available. I think having that capital available would be a wonderful thing. But I think the industry is complex and fragile enough, and the projects, in many cases, I mean, there are exceptions. The large-scale wind and solar projects to some extent, but mostly wind projects, banks with a lot of expertise are backing them and financing them, and the risks have been pretty much washed out. But putting together a package of a whole variety of different kinds of renewable projects and technologies and expecting the investing public to buy into them, to provide capital to them, is a recipe, in my view, for ultimate disaster in the policy arena. Because all it takes is a handful of those going the way of mortgage-backed securities, and everybody will say, this renewable energy thing is ridiculous. Why would we invest? My grandmother lost $100,000. buying a mortgage or buying a master limited partnership.
So why is our standard so dramatically different than a couponing online site that has fraudulent financials
My
and
standard-
is highly incapable of earning a profit?
Yeah, my standard is not different, but I think the standard is different from an operating oil and gas field or a pipeline.
So let's I want to get both Jim and Adrian on this point. Jim, what do you think about this idea?
I'm a market guy, right? So I would, I would let the market, I would be in favor of making the policy changes that allow, REIT or MLP treatment for these kinds of investments. You get the disclosure out there, and people make their decisions, right? Just like the decision about buying any other security. I mean, I don't think we've decided, for example, for better or for worse, after the mortgage-backed securities debacle, that we will no longer allow people in the United States of America to buy those securities, right?
Well, we do hope that our folks doing the AAA ratings on them are a little bit more less credulous than they once were. Adrian?
But, if we were designing this thing from scratch today, we would probably try and come up with something where the government had a role in funding through national labs and through research universities, pure research on stuff that was, 10, 15 years out that was required, and we would ask the government to get involved in the project finance of large infrastructure projects that were interstate, that required, that were for the common good of
transmission
facilities and so on. And then we would just create markets for everything else. Yeah. And I think everything that we've talked about is all about the fact that there isn't yet real trustworthy markets for these products. And so if you're investing in anything from a software startup all the way through to a very capital intensive solar plant, the biggest risk is your uncertainty about the market for that product, because the people who are buying it are regulated and not subject to the same market forces as everybody else, with risks that we all understand that ebb and flow with commodity prices and so on, but they're subject to the whims of state and federal regulators, and so that places unnecessary risk on the whole process. And so it seems to me that if the government could solve that problem, not how to get the capital into the process or how to provide the capital, but how to unblock the market from these projects, capital would flow more freely.
So that tees up my next two questions. Let me start with the premise you just said, because I want to underscore it a little bit, that the government would put a lot more money into energy R&D than it currently does. Bill Gates has I think John Doerr was with him on this proposal, that if you really want to solve concerns about the carbon constrained future, it's not cap and trade, it's heavy investments in R&D that will lower the price of solar, wind, energy efficiency solutions, and the government needs to fund those game-changing technologies through basic research. And part of why that's so important is this sector, less than almost any other sector in the economy, puts less into R&D. Mm-hmm. And a reason that is the case, you have these regulated utilities that don't have an R&D as part of their balance sheet or culture, and that's different than telecom, because in telecom, Bell Labs had an unbelievable R&D machine that was connected to AT&T. In the electric world, there's no such real organization, and in the IT world, so you had Xerox PARC, and even now you've got Microsoft Research or other larger scale R&D efforts. So let's just take a minute. How big of a problem is that in this ecosystem, and what sorts of strategies should we be thinking about? Reuben, you seem like you want to start?
Sure. I mean, I would almost go, the R&D I think is spot on, but the market side is as bad or worse, right? I mean, I thank you, Adrian, for having the courage to try to sell to utilities. Yeah. But the dysfunctionality in the way that market and industry works around any of these issues, they are not incented in any way to embrace or address these kinds of things, because it's not embedded within the market signals that they react to. And there isn't even an avenue for the disruption that came out of the 1996 Telecommunications Act, right? So even with Bell Labs back then, the amount of change that came from that deregulation was Very, very powerful. It did have a bust cycle, but it was tremendous.
So in telecom, you had this 1-2 punch. All this really fabulous R&D at Bell Labs, Xerox PARC, that laid the groundwork for a 20-year cycle of innovation. And to get that cycle, you needed an openness for outside entry, which between the internet's architecture and the deregulation of telecom you got. How do you get that 1-2 punch in this sector, given that you need both the basic R&D to kind of give you seed corn, and then you need the openness for it to actually take root?
Yeah, I think the problem is the second one. I think the R&D
You think the first one's not that big of a problem?
Yeah, I think there are R&D dollars being spent. They're not. I mean, the industry is not spending its own R&D dollars, right? Famously, it spends less on R&D than the pet food industry. But there are organizations, universities, national labs, and so on that are centers of excellence and are doing pioneering research, and there could always be more of it, but that isn't the deficit. The deficit is in the second punch. There is no market, and until competition at all levels, new entrants are allowed to enter the market in ways that will disrupt the incumbents, you're left with this model, which is that you're trying to provide an increasingly perverse set of incentives to a set of incumbents to do things that are not in their own interests. And moreover, you've got an deeply embedded culture of conservatism and sort of and a lack of a desire to innovate in those industries.
I feel actually slightly more encouraged on this point in the sense that I think there's kind of a myth that the Telecommunications Act provided the framework for, or laid the foundation for, the innovation in telecommunications that followed, when in fact I think it might have been the opposite. I think that technology was advancing and change was occurring at such a rapid pace in telecommunications technology that it forced the dismemberment of AT&T and the regional bells and improved arguably service at all levels in the process. The reason I'm a little more encouraged in the utility area is because we tried deregulation, retail deregulation, in a number of states a few years ago, and there are a couple states in which it seems to be alive and reasonably well. But as a general rule, it was a dramatic failure. It was a colossal failure to try to deregulate retail sales of electricity to allow this kind of competition. I think, however, in the 10 or 15 years since, the technology of the delivery of electric energy has evolved and changed in the way it did in telecommunications, to the point now where real pressure is coming to bear, and people are being forced to think really hard about the way that service will be delivered in the future and how it'll be paid for. And I think with continuing expanded pressure from advancing technology, we might see something like what happened in the telecommunications industry.
So let me follow up with you on this, then get other people, and then I'll get the audience involved. When you look back at those last 20 years, and you can say 30 years because that's since 82, think what's happened in telecom since then. The rise of commercial internet, broadband, wireless, GPS, on and on. In electricity, you said there's major stuff that's happened. What has been the major change in electricity technology over that time period? And then as you look forward, if you can see it accelerating, what would you expect?
So we're starting to see the availability of rooftop solar as being incredibly disruptive to the industry. So William mentioned earlier in his opening remarks that the utility industry has to make 30 or 40-year bets on major infrastructure, and that's been a relatively easy thing to do in a stable technology market where you're pretty certain of of a gentle rise in demand and your ability to sort of pre-build capacity to meet that demand. Solar has a really interesting forcing function on an incumbent utility that faces no competition from external retail competition, in that it is to today's world what mobile phones were to the landline guys. It in the telecom space, it creates, if a third of your customers over the next 10 years put solar on their roof, and they are the most affluent third of your customers, then your whole rate-based model has to change. So this idea that you can spread the cost of a network equally on a per consumption basis across everybody that you serve fails. And so I think I agree with Mark in that I think there's an inevitability that technology will be a huge catalyst to change, but But if I was to poll utilities today and look at the number of utilities that are actively recognize this and are engaged and have sort of taken the view that the parade is coming to town, I'm going to get in front of this parade, and versus the ones who are desperately trying to slow it down or are in denial. You would find that there were only maybe 20% of the utilities have actively engaged in this idea, and the rest are, the vast majority are in denial, and then there are some who are in active process to delay.
Which isn't that different than the telecom industry, right?
Exactly right. And there'll be some tipping point.
Qwest
And
did not have a wireless business, the
Yes.
only one of the regional bell operating companies that didn't
Yes.
have one. So
Yes.
clearly they were behind that
Yeah.
curve.
They did initially, and then they sold it as part of, I think, when it initially became Verizon. Before that, it was Vodafone, and
Yeah.
before that, it was
GTE or something.
what is it? It was Pactel. They had this alliance. Anyway, let's go to the audience. We've got lots of students. I'm not afraid to call on some of you, but hopefully one of you will volunteer first. Yeah, Nick, you're one of the people I was going to call on, so that's good.
I think this will tee into what you guys were just talking about, but thanks, Walker. What is the federal government's role in ensuring that the downstream electrical concerns, basically everything besides generation, develops, and that's either through financing or regulation, to keep abreast of the new investments in generation, so that the market not only benefits from efficiency, but also that it just doesn't taper out, so they can take advantage of all the new renewable sources that will come on the market in the next 15 to 25 years.
Let me give that a gloss, which is in telecom, one of the beautiful things about Bell Labs is it understood it was a system, and it looked to innovate across the system in ways that may be complementary. Rooftop solar and electric vehicles are going to put a lot of stresses on other parts of the system that may not be getting the innovative development it needs to cope with what's happening elsewhere. How big of a risk is that?
I think it's significant, and I think that your question started with what does the federal government need to do on this. The federal government has almost no jurisdiction over anything other than major transmission sort of things, and so it comes down to states, and I think that there's been a lot of work done, right? There's a lot or billions of dollars being spent on upgrading the grid to make it adaptable, to move it from a sort of one-way analog sort of carbon-based system into one which is digital and smart and two-way and interactive with new types of load. So I think one half of this is infrastructure-driven. It's make sure that the various bits of plumbing that are required to do this are in place, and that they use open standards and things that will foster innovation. The second is regulatory, and that's about creating the environment for companies that drive energy efficiency or have more efficient offerings or more renewable offerings to be able to compete against those that have less of that in an open market.
Jim, let me do a follow-up which fits here in the earlier, which is you deal with VCs who are doing all sorts of sectors, and among the sectors, I'd say education, healthcare, and energy have to be the ones that many VCs are like, I'm not touching that because the customers there are really hard. They're not going to be at the bleeding edge, and they're going to be in a culture that's much more conservative. How big do you see that as a block in terms of getting financing and innovative companies into these spaces?
Yeah, I mean, I think uncertainty about government policy is a big issue. I mean, one analogy is to the healthcare sector. So you look at biotech. We put huge amounts of money. NIH and NCI put huge amounts of money into basic research in universities, and this university benefits from hundreds of millions of dollars a year of that. And so we've got all of this great stuff that's coming up in the labs. Very hard to get that financed now. Why? Because every VC has a horror story about dealing with the FDA, where erratic, unpredictable, bizarre behavior killed a company after hundreds of millions of dollars was invested. So that's it. And again, when you don't know what's going to happen with subsidies and what's going to happen with PTCs and these other things, it makes it tough. So that's why I mean they're looking for sort of the daylight where you're not subject to those kinds of things, and I think the investment opportunities there. But if you want to see investment in some of these other areas where people have been burned in the past due to uncertainty about, or just changes in policy. You know, the policy's got to change. Other questions? Let's go in the back.
Hi, I'm Alex Carline from the Interdisciplinary Telecom Program. I wanted to ask a question about kind of rolling back to basic research and development. I'm struggling with this idea of how we can both prevent government from being like a very poorly staffed and poorly run venture capital firm, but at the same time can also meet some expectations that the market's not meeting, right? So there was some discussion about things that would resemble like regional innovation clusters, like Bell, like an office park, Xerox Park, or Bell Laboratories, or funding basic R&D through RPE or national labs. But if we understand that the requirement exists for these technologies to be developed, then why aren't these being financed collectively through the industry? Why aren't people pulling together to do this?
So Alex is kind of asking us to refine the point. Where exactly in the funding ecosystem should government step in? Where are the holes? Yeah, go ahead, Mike.
Well, I'd like to go back to the loan guarantee program because it sort of invokes that. First of all, most of that spending was not on manufacturing, but really on generation projects, which had a really completely different risk profile. And I think it was very effective in supporting technologies such as CSP, which were so capital intensive and not applicable to the current financial environment.
CSP stands for
concentrating solar power. So the larger steam-driven power plants that are solar. And I think to the extent that government can leverage some funding with a credit enhancement, or perhaps not as invasive as a loan guarantee, but to use money to sort of induce private investment, at least for the first couple of times. We talked a little bit about securitization and how to get private wealth and others to trade in products, and we can argue about whether or not that's a good idea, but to the extent we think it is, then I think getting over the hurdle of the first 1, 2, or 3 of those until the market is comfortable with them, then the federal government can play a valuable role in either credit enhancements or some other sort of modest guarantee that represents sort of what's called a first loss reserve or something of that nature, an insurance policy, so that the ultimate financiers are not hit immediately upon losses. So, one idea.
Another one, within RPE, in many of the grant applications, you actually have to stipulate why your private capital backers are not willing to invest in the thing you're asking for money for. And so it becomes a conversation within the company as to what's within our innovation sphere and what's a step beyond. Mm-hmm. And in this case, it's like big long shots in battery research, and that's a step beyond, right? You know what's commercializable in the next 10 years, and this isn't, but it's very, very powerful. So someone needs to do it, and so in the application you actually articulate it, and so they have experts within the DOE that somehow ascribe merit to the quality of that statement.
But think about the illogic of that situation. Before you can get in my door and ask me for money, you have to prove to me how bad your idea is, that no one else will take it. Then once you get inside the door, I'll take all the information you gave me about how bad it is to beat you up and not give you money. I mean, that's a bit of an overstatement or an oversimplification, but there's something about that model.
Well, are you a skeptic of RPE then, Mark?
What's that?
Are you a skeptic of RPE?
Am I what?
A skeptic of RPE?
No, not at all.
But everything has perverse practices.
Yes. Yeah.
Well, this is important because for those law students here, the 2 laws we don't do a good enough job teaching about is the law of supply and demand,
Yep.
and the law of unintended consequences. Right up here.
Hi, Ken Whitehell with the Drive Sunshine Institute. We're scaling up to 2,000 corporate test drive events annually with electric vehicles to drive market demand for renewable energy. But despite Mark's crafty advice to not invest in the group on renewable energy, We're also leading the national call for every 401k plan to offer a renewable energy project finance mechanism within it in order to tap the $7 trillion that are in 401k plans and be able to flow them through project finance. So I'll pose my question to a friendlier Mike. And Mike, in terms of developing a right-like mechanism that's been traditionally available in 401k plans to invest in real estate funds, could you see the trade associations, American Wind Industry Association, and other organizations working with NREL and federal policymakers to develop a renewable energy right-like mechanism? How can you see that flowing over the next 2 years?
Right. Well, while I advocate for these types of financial vehicles, we're not trying to create them ourselves. We're just trying to create an environment where the market picks them up and takes them by sort of standardizing the projects and making the data available so that the risks can be assessed. But to your question more specifically, one problem we really have now is that with the tax policies, that makes it very difficult to take another portion of the investment in renewable energy and make that available to non-tax investors. And as the tax policies go away, that will be likely easier. But really, the industries are sort of always clamoring to keep those tax policies because we're somewhat addicted to them, because they do provide a strong benefit. But if we go away from them, then we might have access to this additional sources of capital. So there's a real tension there. And that's sort of a bridge we haven't really come over yet. But I think to the extent we can create the environment where these securitization vehicles can take off, then I think the industry will be less apt to go to Congress and say, "This, we absolutely have to have this." That they can see the transition in front of them a little bit better to the extent we can create that environment.
Although there could be a little chicken and egg problem, because if you had the tax credit crowding out some of those other vehicles or getting in the way, you wouldn't allow that market to develop. So to ask the question a little differently, and I guess to take a little hostile tone, sorry, just for fun, how does the industry wean itself off these tax credits? When is it enough, and how do you make that transition away from them?
Well, really, if we had any decent policy design, we would sort of transition them down, not wait for that.
To his credit, that's what Tony Clark said with wind and solar. Take the two, put them in tandem, and transition them down over a period of time.
Right. And I think if we had some sort of organized ramp down, then the industry could get comfortable with that. And also just a long-term understanding of where the policy was. If Congress could just get together, and even if it was a relatively small amount or ramp down to a small amount in the next 5 years or something like that, then I think the wind industry could understand what their investment environment looked like, and that would really help just create a lot of certainty in the industry, and they can understand exactly where their cost effectiveness of their investments lies.
Another way to do it would be to come up with a really crafty legal strategy to create a synthetic tax equity vehicle and expand the scope, because that is an incredible return if you have capacity to participate in and are willing to understand it.
Like
maybe
refundable production tax credit, something of that nature.
Well, there's an easy policy way to solve it, but if you want to be this is a law school, so if you want to come up with a good legal mechanism to enhance access to those vehicles, it would be.
So I think we have some good ideas for law school student research here, and our panel has given us some great food for thought. I want to thank you guys all. This was a really great discussion. Thank you so much.